Welcome back to Indianomics and to our spotlight on steel. Since China has been the deciding factor for global steel prices, we have now invited all the way from Beijing Mr. Kevin Bai, the consultant at Crew Group, which is widely regarded as the best think tank on metals and steel. Kevin, thanks much for joining us. Hasn't the rise in prices since December led to more capacity utilization? Do you expect more supplies and hence steel prices to fall?
To be honest, the profitability at steel mills in China has been improved significantly, and some of the traders are making significant margins by selling low-price stocks. And this has encouraged mills, especially in Hebei province and Shanxi province, to come back to the market. So the answer is yes, there are some production resumption since the price rise, and this can be proved by a year-on-year increase of Chinese crude steel production in March, about 2.9%, and we also hope that April production will be higher as well. And also, I just mentioned that the output resumption is below expectation. There are several reasons behind this. The first one is it will need a lot of money to restart furnace, but currently speaking, the financial condition at steel mills and credit availability for the steel industry is still tight. And the second one is given hiking prices, it is easy to become cautious, rational, and people and steel mills are worrying because they fear that the price hike is just relatively short-lived. And the third reason, I think, there are still stresses and pressures from the government level to control output. So that's why.
So, Kevin, how do you see the prices of Chinese steel exports for the rest of 2016?
Firstly, I must apologize because we don't forecast on Chinese export prices at the moment, but we do have an estimate of Chinese domestic prices in terms of hot rolled coil. It is still likely to face some downward pressure, especially in late Q2, that is, say, May to June. And given output resumption, as just mentioned before, capacity control and credit tightness. So these are all the downward pressure for further price increases. And it is also very likely that prices will see correction very soon, given the unbelievably high prices at the moment. Actually, today, a little bit downward correction has already seen in the Chinese domestic markets.
So what do you think will be the average domestic steel price in China in 2016?
Yeah, according to our research, and the annual average is around 2,500 RMB per ton for hot rolled coil. It is from our forecast made in early April. But I must admit that it should be higher as this forecast didn't feed in the latest prices. And the latest prices are definitely much higher than we expected. So the average will be higher if we see it right now.
And how much is that in dollar terms?
It will be less than 380, I suppose.
And one last question. In general, will steel prices in 2017 be higher or lower than prices in 2016?
From the current price cost condition, we don't expect the prices will fall to level that we seen late last year. Because it's based, the level we see last year is based on a very low iron ore and coal prices in terms of production cost, and at the same time, mills were selling them below marginal cost to minimize losses. but they cannot keep doing that because they're losing money, and we've seen a lot of mills actively shut down their mills for good. So I don't think, and for CRU, we don't think that for now, given the current price cost additions, that price will happen.
Well, thanks, Kevin. Thank you very much for joining me today. Well, here are the key takeaways from all my experts. One, steel prices will definitely not fall back to the $250 level. Second, Neelkanth expects that steel prices will actually remain at current levels or even gain a bit for the next 9 months at least. Mr. Rao thinks steel prices will probably fall a bit from the current $480 to closer to $400. Kevin also doesn't expect steel prices at current levels. He expects them to come to around $400. Fourthly, the key reason why prices will be maintained and not fall to $250 is that producers are wary of restarting mothballed capacities. As well, banks are not willing to lend to them. And more importantly, demand is also picking up in China because of the fiscal stimulus. A fifth takeaway, those with in-house iron ore are going to benefit a lot in terms of a margin boost. 6, not much relief is expected for Indian banks because some of the stressed steel companies have so much debt that it can't be bridged even with the current higher EBIT margins. Another takeaway, our experts don't expect too many M&As in the Indian steel space because banks and promoters are still expecting much higher prices than buyers are willing to pay. Well, that's it on this edition of Indianomics. Thanks for watching.